Good afternoon. It's Jeffrey Christian. It's about 1:40 here in the afternoon in New York on Friday, the 31st of May. It's been a very busy day, so I'm running a little bit later than usual in making this recording. I want to give a market update, but first I want to talk about some rational price projections. And in between the market update and price projection talk, I will speak about the economic environment, which is clearly what's going on with precious metals prices and markets recent times. We used this chart in our silver yearbook launch last week, 2 weeks ago, and in doing that, using that program, we cut off the lower right-hand part, and people couldn't quite see it. So I wanted to reproduce it here to make the point. These are CPM Group's 10-year silver price projections, real and nominal, from December 2021. And you can see that in December 2021, I've blocked out some of the 10-year projections. We took projections at that point through 2030. But you could see that in 2021, we were expecting nominal silver prices on an annual average basis to exceed $40, which would have been a very big jump from the previous record around $34, $35 in 2012. We had been projecting as far back as 2021 period of sharply higher prices, and I'll talk a little bit more about that in a second. Actually, higher projections than we have now. We've lowered the projections, and then you can see that we were predicting that they would begin to decline, and you can tell by the sign of blackout that what we were doing. Anyway, I had put this used this in our silver yearbook launch. My colleagues thought that we were giving away what we charge a lot for, which is our long-term projections. I thought that it was probably worth it. People complained because they couldn't see the years at the bottom. So I wanted to reproduce it here and go a little bit further in discussing that. And this is our projections of silver several years ago. These were our gold projections at that time. And you can see that we also had very sharp increases. We had nominal prices averaging more roughly $2,600 at a peak that we were projecting around 2024, 2025. Now, in both of these price projections, it's very important to show you that, we were saying that we thought we'd enter a period of sharply higher prices 2024, 2025, and we are. But it's also very important to note that we had been projecting a plateau of prices in 2021, 2022, 2023. It's not so obvious in the silver, but it's very obvious in the gold one. So I think it's important to point out that, we got it right talking about the possibility that economic and political conditions in 2024, 2025 could lead investors to pour into precious metals and drive the prices higher. This is what you're seeing. But it's also very important to point out that we didn't see that happening in 2022 or 2023. We weren't, the guys who were saying, hey, gold's going to $10,000 any moment now, or silver's going to $750 any moment now. We were saying, no, given the economic and political environment as we project them to unfold over the next several years, we think 2022, 2023 are going to be a period where we're moving toward that price hike, but we're not there yet. I want to go a little bit further. This is from February 2018 report. And you can see here, this is our gold projections. You can see here, we were projecting higher gold prices by 2024, 2025, again then. And in fact, I'll just go here where we put it all in writing so people can study it so they don't make stupid comments the way they sometimes do. You can see that those February 18 projections, actually, we were projecting higher prices starting around 2020. And they actually started in, I think, July of 2020. And our projections of sharply higher gold and silver prices sometime after 2017 were made in 2011 and were based on similar long-term analyses that date back to before 2008 and 2009. As I said, it's important to understand, hey, yeah, we got it right. That's pretty good, all modesty aside. And very much more important, perhaps, is the fact that we weren't saying, oh, it's going to happen any second now. Yeah, we're not alarmists. I point this out just so you know, and that we have a high degree of confidence having expected what we're seeing. Now that we're seeing it, we have a pretty high degree of confidence that our analysis, our data, and our analysis have probably a high degree of credibility and accuracy to them. So right now we're sort of saying, hey, this is good. Yeah. In late 2008, during the financial crisis, there were people in the financial markets and in government agencies who were saying, we didn't study this kind of market in college. We're not quite sure where we are economically and what it means and what we should be doing. We today don't have that lack of confidence in our expectations. And for those people who foolishly write that I'm a perma bear or I'm a bear or, oh, I finally turned bullish and I'm now projecting $30 silver, they're years too late. And please distinguish me from saying, hey, it could go to $30 or $35 from those people who are saying once it breaks above 30, it's going to 750 or 1,000 or anything else. It's a world of difference between what we project and what they project. By the way, gold price and silver price and copper price and palladium price are off sharply today following a PCE release, which I'll talk about in a second. Yeah, the reality is, hey, we've been pretty good at this market because we study it, because we don't project prices based on beliefs. We project prices based on knowledge, research, and analysis. So now let's talk about the economic environment. The economic environment keeps chugging along. It's pretty good. I'll show you some charts on employment, unemployment, GDP, and personal consumption expenditures, and the personal consumption expenditures price index, which came out today. GDP, the second guess for the first quarter, came out yesterday. The economy is showing strength. Growth is good. It's better than many market participants had thought, and still believe, not think, believe. There are people who are telling you that the economy is in much worse shape than it is. Now, housing prices are off in Texas and in Florida for reasons that have to do with Texas and Florida. Housing prices are not off in most of the rest of the United States. So the housing market's not collapsing. It's got a lot of problems, but it's not collapsing. Market participants are looking at this and they're saying, okay, inflation is not declining, it's going to rise. And inflation is slowly declining. It's stickier than many market participants have believed, but it's pretty much in line with what has been pretty evident for the last 2 years since inflation shot up in 2021 in the aftermath of the lockdown and the massive fiscal stimuli that were put forth in the United States and most other countries of the world to keep people alive during the pandemic and the global lockdown. Market participants are looking at where we are economically, and they're vacillating wildly in their beliefs. They're swinging from the continued hope of an imminent interest rate cut to worries about inflation rising again. And this has led to some strange views where, stronger economic conditions are bad for commodities, and weaker economic conditions are good for economies for commodities because it suggests that interest rates may fall sooner. And as I've said repeatedly, one should not be hoping for lower interest rates. If the Fed can see that even with all of the fiscal policy problems going on and pockets of weakness in the real economy, supply and demand of goods and services, if the Fed can see that the economy keeps chugging along and inflation is slowly coming down at 5.25% Fed funds rate, it will say, hey, we've got interest rate policy right. At this point in time in the economy, there's no reason to cut interest rates. The Fed will cut interest rates when they see much more definitive indications of economic weakness heading toward perhaps a recession. So don't hope for lower interest rates, because when you see them, it's going to be a sign that things are getting much worse economically. Let's look at some data. This is the U.S. GDP. It was revised out from 1.5 to 1.2% for the first quarter. This is the second estimate. The final figure will be another month or so away before it's coming. But again, 1.2%, that's not bad. And if you compare it to all those little squibbles really going back to 1980, 1990, it's right pretty much in there. It's a little bit weaker than we'd like to see, and it is weakening. It is perhaps slouching toward a recession, but it's not in a recession. Don't believe in black and white analyses. Look at the shades of gray. Personal consumer expenditure levels. Look at them rather than the PCE prices. We'll get to the PCE prices in a bit. I keep hearing people talk about the collapse of consumer spending. Consumer spending was about 5.7% in March and in April. 5.6, 5.7%. That's higher than it was at any time from 2006, late stages of that economic expansion, through the Great Recession, and through the period of zero interest rate policies, when some people will tell you all that money was being given to people who were spending it. Personal consumer expenditures actually are higher today than they have been for that long extended 15-year period. Now, they're down from the spike that we saw in 2021 when everybody came out of their houses and started spending money. And they've been sliding ever since 2022 for a variety of reasons. But there's still a lot of rope, a lot of slack in that rope. And we're not in a situation where consumer expenditures are collapsing. I didn't put it in here, but the Bureau of Economic Analysis has another data line, which is personal consumer expenditures, less food and energy. And if you take that out, it actually spiked sharply higher to much higher levels in the past month or two. Basically, you're seeing people having to spend less money on food and energy. They're spending it on other stuff. And in April, expenditures less food and energy were higher than they were, I think, going back to about 1990, late 80s. So a lot of rope, a lot of slack left in that rope. Unemployment also remains historically low. And then if you look at the PCE price index, which is what the Fed prefers over CPI, PCE price index, including food and energy, was about 2.7% in April, which was unchanged from 2.7% in March. And if you exclude food and energy, it was about 2.8% in both March and in April. It's very interesting to watch how the markets reacted to this data. With basically flat inflation changes in the PCE indices. The gold and silver prices and copper were off in the morning before the 8:30 release. When the data was released, the prices rose a little bit, like $6 on gold or so. And then later, as the day advanced, people realized, okay, this doesn't necessarily forebode a weak economic environment where the Fed's going to be cutting interest rates. So you saw gold drop. It's off about $20 on the day right now. Silver's off about $1.10, but it was off even more earlier in the day. Palladium has been off sharply, as is copper, stocks, and corporate bonds. And it's very important to understand that stocks and copper and corporate bonds, because what you're seeing are financial markets reacting across markets. It's not one bank whacking the silver market. It's a collective view that financial markets really don't know where we are economically at this point. And I didn't mention, I put it in writing, I didn't mention the political situation, which actually compounds all of this uncertainty and adds to the volatility of consumer and financial market attitudes, which adds to the volatility of the prices. Here we are with gold. Again, I put in the main chart since January, February, kind of moving sideways, $2,000, $2,100. Started to rise in March. People started getting interested, rose much more sharply in April. We've been trading sideways pretty much above $2,300 since the second week of April. And we may continue to do that for a while. On the right-hand side, I took the prices back to 2014 so that you can see that long period of gestation from 2014 into 2019, 2020, before the prices started rising again. We would not be surprised to see the price come off June, July, August. But we think that in the final 4 months of this year, political and economic conditions may actually start being more significantly weaker and worrisome to financial markets. Financial market expectations may be more negative than the actual underlying data. And the political environment, both domestically in the United States and in other countries, and internationally, probably will be more hostile than it is in the end of May, all of which we expect to contribute to increased investment demand for gold and higher prices in the final 4 months of this year into next year. Sort of the same way we've been saying for the last 15 years, 18 years. Kind of sound like a broken record. Silver prices, a very similar pattern, sideways January, February, started moving up in March, moved higher in April, moved even higher in May. It kind of plateaued. Some people thought that might have been some congestion in the May COMEX contract, silver futures contract, since there was congestion in the May copper contract, which contributed to a very sharp increase in copper prices. It's our view, looking at the data, that the May roll into July actually was behind the market before the price started rising. So our view is that the strength in silver prices after the first week or so of May was not a function of the May roll into July, but rather other factors in the silver market, specifically investment demand in a relatively tight market. Now, in July, you have in the July contract The last I looked earlier this week, 733 million ounces of open interest in the July contract. That will largely be rolled forward, i.e., bought back by the shorts and then sell forward into September and December contracts. That should be expected to keep prices higher and possibly cause prices to spike higher in June before coming back off. And I think I talked a little bit about this earlier in the week, and it's there, and you can see it. And again, on the right-hand side, you can see the longer period of silver prices gestating between, say, $13, $12.80, and about $16, $17, $18 before they started rising, really in 2020. Platinum and palladium. Platinum prices have risen. They've gotten back up. I'm looking right now. It's $1,043 for the July contract. There is a potential for some further increase in platinum prices, but by and large, we do think that it's going to continue to be kind of range bound, broadly between $900 and $1,000. So beyond June, we wouldn't be surprised to see the platinum price come back off from where it is now. And palladium prices continue to decline. And I put in the longer term charts here so that you can see the long period of gestation in platinum prices, but more importantly, you can see that for palladium, from 2014 to 2019, the price is basically below $900, $1,000. It shot up starting in late 2018, and it rose through 2020 into 2022, and then spiked higher when Russia invaded Ukraine at the end of February 2022. And then it's been in a long decline since that time. And we sort of expect that long decline to continue, although we think the bulk of the decline is behind the market. Palladium is now at a discount to platinum. It historically was at a discount to platinum until some point in the last decade or so. And it's our expectation that it probably stays at a discount to platinum going forward. And then I put in copper prices because, as I said, very dramatic move in the middle of May. Some of that was congestion in the COMEX market. Some of it was fabricators who had reduced their working inventories in the expectation of a recession, finding that they needed to buy spot physical metal, and there were some supply interruptions and constraints. So you had physical supply and demand factors as well as COMEX-related issues. COMEX-related issues are behind the market. These are actually LME prices. You know, we saw the price spike over 11,000. It's back down to just above 10,000. And our base metals advisory for May will be released later today, and we'll have projections for the next 3 months and the next 2 years in there. But we do like copper. That's all I have for now. Talked a long while. I'm sorry. You can go to our website, cpmgroup.com. You can buy and download our ebooks, the 2024 Silver Yearbook, the 2024 Gold Yearbook. You can pre-order the 2024 Platinum Group Metals Yearbook. You can look at other reports that are available. You can read about some of the consulting services we offer people, ranging from producers to processors to industrial users to a full range of investors, central banks, governments. Anybody with a large financial exposure to commodities is a suitable customer for CPM Group. If you want to communicate with us about ways we might help you manage your exposure to commodities, write to us at info@cpmgroup.com. In the meantime, take care of yourself, take care of those around you, be good to the world, try to do something nice, and we'll talk to you next week.